Can banks turn around this entire market?
Well, that's a lot of pressure, but I'll tell you, I think there's a lot of bad news in these stocks. Tomorrow's a really important day for earnings. JP Morgan, for example, kicks off the earnings season. We think it's going to be amongst the best quality earnings that's out there. Jamie has an 8:30 conference call tomorrow. I think it's an important one to listen to. And I think that there's a lot of bad news in the stocks, and they could bounce off of this, is my opinion.
Jason, clearly banks are meant to be one of the sectors that benefit from rising rates, and rising rates have been one of the big catalysts to spark broader equity market declines. What's the key factor you'll look for in these bank stocks' earnings that would prove to you that they are a beneficiary of rising rates?
Sure. There's been a lot of focus on net interest margins, from 1995 through 2015. There's only 2 of those 20 years net interest margins went up. Yet they expanded in 2016, 2017, and we look to expand again in 2018, including, the third quarter and possibly into next year if the Fed continues to hike. So while the Fed's raised rates, you've seen banks, just earn more on the asset side of the balance sheet, and they've lagged in terms of repricing their deposits higher. And we think that trend will carry into the third quarter as well as the fourth quarter.
David, what's your take in terms of the key things to watch out for when these banks report tomorrow?
Well, I think they're going to tell us that the last 3 months ended September were fine, and we all know that. The market was good. The economy's been good. I think what I'm looking at is, or looking for, is what their loan growth outlook is. Some of the conferences after Labor Day in New York or other parts of the country, the companies have been telling us that loan growth has slowed. The rise in rates has been good, but there's pressure on deposit costs, which is now starting to impact the smaller companies more than the bigger companies. So there are some headwinds building, but I think you're going to hear from the best companies tomorrow in terms of a flavor for how the overall economy is doing. So I think it will, they'll tell you what you expect. Jamie Dimon's going to do a great job of telling you things are good. I'm not sure if that's going to be enough to help the whole market, however, as we all hope it would.
Yeah, Tom, what are your expectations on loan growth in particular? I know you're overall optimistic and rosy, as you usually are on the group. But what about underlying demand for loans?
So we think that it's going to be, for the biggest banks, maybe 2 to 5% loan growth, which, look, there's been a slowdown in the third quarter. That's been the pattern of prior years. Typically, the fourth quarter has shown a good pickup. And we are looking for flat net interest margins. So this quarter may not be as robust as other prior quarters have been, but we do think this will be the 8th quarter in a row that the banks have produced double-digit earnings per share growth, and the stocks are off a lot. If you look at these stocks on a relative PE multiple, the large regional banks to the overall market, on a relative basis, they're cheaper now than they were before the election. So they've already, I think, embedded a lot of this news. And the reality is, I think their balance sheets are in good shape. I think they're generally going to tell a story of a little bit weaker growth, but I think they're still going to tell a pretty good story overall.
Jason, what's your top pick going into earnings season, and why?
Yeah, no, I mean, not to echo what the other two said, but, we're constructive on JP Morgan. We think we're 4 cents ahead of consensus tomorrow, so I think that's the most upside. But, I think overall we're, generally constructive as well. We think the overall trends will be good. You'll get, mid-single-digit revenue growth, resulting in, double-digit earnings growth for yet another quarter. With ROA and ROE profitability metrics, basically at post-crisis highs.
David, do you prefer banks which have got classic exposure to the U.S. economy and the interest rate curve, retail banks, as it were, or the sort of investment banks, the purer guys like Morgan Stanley, Goldman Sachs?
I like the traditional banks. I think the money movement guys or the brokers, nobody's paying for that. That's a low PE business. When I started 30 years ago, that was a high PE business because it was growing, and it grew rapidly for 25 years. Now, nobody wants to pay for sales and trading or IPOs because it's a one-off episodic business. I think you want to own the good deposit franchises, the guys that can hold deposit costs, make loans, and then hopefully, build on, cost efficiencies, technology platforms, and things like that in the future.
I mean, Jason, it sounds like all of you are saying the valuations look good, the business is in pretty decent shape, the results are going to be good. Does any of it matter, though, if we see a big move in Treasury yields one way or the other?
It's a good point. I mean, the bank stocks outperformed, up until today, the last 4, 5, 6 days. as the 10-year backed up, the 10-year yield backed up significantly. 10-year yield came in today, and the stocks underperformed. So for much of the last, couple of years, the banks have certainly been tied to what the long end of the curve has done, rightly or wrongly. And it does appear to be that, the macro factors kind of trump the micro factors, at least kind of on the day-to-day basis. I think over time, looking out over the next year or so, a decent fundamental performance coupled with kind of a regulatory rollback theme and very active capital return, both dividend and buyback, should allow these stocks to outperform over time.
Tom, what's the big risk? What would spook you and switch you from being bullish on the sector to bearish all of a sudden tomorrow if it reared its head? Would it be provisions and credit costs or what?
If any of these macro factors really start embedding into the economy and you start to see them in the numbers, that's something that I think that might change our outlook. But the reality is we just don't see that happening. Look, these are real risks that are worth watching. But I think one of the good things for the stock market's going to be over the coming weeks, we're going to start to hear earnings reports. And my instincts are is the here and now and the medium-term outlook is one that's probably pretty good. And I think you're going to hear the management teams probably talk a little bit about what potential risks could be. But the here and now, I think, is probably going to be pretty good. And I'd like to reemphasize the self-help part of it that one of the prior speakers mentioned, which is there's going to be a lot of share repurchase. And we're looking for tomorrow. The thing to watch in Wells tomorrow is not the revenue number. I think we all believe that's going to be weak. Watch the expense number, because there's some terrific expense control going on in the big banks. And I think the two you want to watch the most there are Wells Fargo and next week Bank of America. And that's going to be good for shareholders, I think, for performance.
As you say, Wells have got a huge buyback program, which I'm sure they'll kick into gear again once they get through the earnings.